there's the increasing perception of public markets becoming more and more short term, and so having businesses that are looking to grow for the long term don't necessarily see the stock exchanges as being as attractive perhaps as they once were.
Welcome to the Podfolio, Willis Towers Watson's investment podcast series, where we'll give you an update on the latest developments across global markets and talk to expert guests on hot topics that matter to institutional investors and their portfolios.
Hello and welcome to the Portfolio Investment Podcast and our mini-series looking at the different asset classes. Now, we're going to wrap up this series soon with a discussion of how to pull all these different elements together within your overall portfolio. But I do just want to look at least one more asset class. So today we're talking about private equity, and I'm delighted to give a warm welcome to two special guests who are both specialists in private markets. So we've got Joseph Bassey-Duke. So welcome to the show, Joe.
Hey, Lot.
And we've also got Ben Leach. Hey, Ben.
Hey, Lot. Thanks for having me on.
So let's kick off with the obvious question then. What is private equity? And let's start with you, Ben. I think we all know what equity is. So what's the significance of the private bit?
Sure. Well, I think quite simply, as you said, equity is investing in companies' stocks, and in private equity, you're just investing in companies who aren't listed on a stock exchange. So it's really the business of investing into and making returns, as I say, from private companies, not from public ones.
And why do companies prefer to go down this private route instead of being on the stock exchange? Because I thought the whole point, if you're setting up a company, you're trying to grow it to a certain size, and then you float it on the stock market in an IPO, and then you make yourself rich, right? I mean, why not just do that?
Well, yes, that is still a path to making yourself rich, Locke, if you'd like to give it a try. I guess increasingly we've observed companies wanting to stay private for longer, and I think two major reasons for that. Firstly, the abundance of private capital. So fundraising by private equity managers has continued to reach record highs, and the amount of dry capital, that's the amount of money that's been raised but not been deployed into the market, is somewhere just short of $2 trillion. So there's a lot of capital chasing private investments first and foremost, which means the owners of businesses can find partners and capital to help them grow those businesses without needing to go into the stock market. I think a couple of other reasons is that going public is fairly costly. Right, so there's a substantial cost to going public on a stock exchange, and substantial costs and regulatory requirements of maintaining a public company versus a private one, which means it's less attractive than it has been for some time. And I think some of the statistics that support that, in the US equity market, for example, had around 8,000 companies in the late 1990s, but just around 4,000 today. So a halving of the number of companies listed on US stock markets. So as I say, a few reasons for remaining private versus public. I think that the last one I would just say is that there's the increasing perception of public markets becoming more and more short term, and so having businesses that are looking to grow for the long term don't necessarily see the stock exchanges as being as attractive perhaps as they once were.
And obviously we will shortly come on to talk about specific examples, so some of these companies with maybe that kind of longer term vision. But before we do that, I just want to touch on the overall investment case for private equity, and I normally think if you're motivated to invest in anything other than the simple stuff of mainstream equities and bonds, you're typically looking for one of three things. So you're looking for better returns, or you're looking for lower risk, or you're just after something that behaves differently to the mainstream markets for that kind of diversification benefit. So which of these would you say is your main motivation for investing in private equity?
So I think that one's fairly simple, Lock, in that predominantly clients are looking for increased returns by investing in private equity.
Right.
We typically find that clients make an allocation to private equity from their public equity part of the portfolio. Not always, but typically they do that. And the enhanced returns that can be on offer in private equity really come as a result of what we call an illiquidity premium. So locking up your capital for a period of time, and then a skill premium, which is the ability of the private equity fund managers that look after capital to go and buy businesses, improve those businesses, grow their earnings, develop the strategy, potentially look at other transactions and alike that mean their skill set in being active within that business, within those companies that they're buying, leads them to having the ability to enhance those returns over time.
And can I just ask a kind of maybe a silly question at this point, just to be kind of 100% sure? I mean, private obviously means the stock is not traded on a public exchange. And so how do you actually, and maybe I'll throw this at you, Joe, how do you actually get hold of it if you want to make an investment? Is it always through a fund of some sort then?
Sure, look. So I think it's best if you look at this, I guess, from basic principles and by thinking about, why would a founder want to sell the company, right? Why would they want to sell their baby that they spent years building up?
Yeah.
And these founders tend to sell, I guess, for like a multitude of reasons, right? They could have a life event, they could be looking to retire, or maybe they want to start a new business, or maybe they believe that they've taken their company as far as they can, really, and they, want to hand it over to someone else that can continue to grow the company after they have moved on. But buyers, on the other hand, right, who actually want to buy these companies could be either other businesses, right? So big less strategic players that want to bolt this business onto what they already own and take on their assets, take on the customers, or maybe their services, and join these companies together to gain value. Or they could be actually financial players that want to hold the companies for a finite amount of time, make some changes to the company and then sell it on. And that's typically what you find within like private equity. So how do these financial players source the companies that they want, right? This is one of the harder things you can do within private equity, because for every deal that a PE company invests in, they will typically look at dozens of actually other companies before they actually find one that they like. So the PE firms would typically have an in-house sourcing team, right, that uses their own professional network or their investment banking relationships, or like in recent times, actually, they use like some data platforms, where firms and companies up for sale then end up getting listed to find the companies that they could be interested in buying. But actually, what I'd say is that these deals, when by the time you see a company already up for sale, right, you have significant competition from other buyers that might be interested in that company. So the pricing tends to be a lot richer, and the valuations that are paid for those firms tends to be a lot higher. So in our view, the best deals are often sourced, when you actually get access to a company that's not up for sale, right? Maybe the founder hasn't even thought about selling the company to begin with, right? It's not on the market. And this is where private equity firms have to use almost a business development function to try and convince the manager that, they should consider potentially an exit. And given the fact that there is just much less competition for these deals by their very nature, pricing tends to be better, and this is where we see the best opportunities. So if we want to think about how an investor can actually get hold of these companies, right, you would often typically invest through a fund structure. Ben had mentioned this earlier. It's a fund. It's a closed-end fund, typically a 10-year life, and the private equity manager manages these funds with investors, giving the capital for the managers to use to find these companies that they want to invest in, and that's the typical structure that the market operates in.
Okay, so that's how you buy it, and if you want to sell private equity, presumably the same manager will now have to find like a private buyer to take it off your hands, and that's obviously a more roundabout way than using a public exchange. So I just want to ask you, Joe, whether there are any potential issues around liquidity. So in other words, you can't find a buyer easily, but you really need to get your money back, so you have to lower your price or something, and so on.
Yeah, Sherlock. So there are two ways that I guess you can think about selling. You can think about selling from the like perspective of the company that you own, that the PE manager owns, that they're looking to sell. But also you can think about selling from the perspective of the investor in a private equity fund who is looking to exit the holding. And I'll touch on both of those separately. I'd mentioned that the people who would be potential buyers of a private equity company before could be either like strategic buyers, but also other financial buyers as well. And when a private equity manager is looking to exit a company that they already own, those could potentially be the same buyers that they could look to sell to, right? So they could look to sell to, another company that could bolt on this PE-owned company as part of their existing firm, and take on the assets and drive value through like synergies that way. Or they could sell it potentially to another private equity firm that could look to implement a new strategy to drive value that way. But Ben had mentioned IPOs, and IPOs ultimately remains, one route as well that managers could choose to exit a company and then put it to the public market. But of course, you are then dependent on what pricing is in the public market. So you then tend to be like dependent, if you're looking to do like an IPO, on the pricing in like the public markets much more broadly. But also, this is a route that only tends to be available I'd say to the largest firms. So small and medium sized companies actually don't tend to find IPOs as a route that they can actually pursue. And then the other aspect that you can look at, which I mentioned, is how you as an investor who owns a private equity stake, in a fund can actually exit. And we think that the kind of liquidity of these funds, tends to be underestimated. Yes, they're closed-ended. Yes, they tend to have 10-year fund lives, right? But each private equity fund will have a number of companies that over that fund life managers are going to exit. And every time that they exit, the managers actually return capital to investors,
Right.
hopefully at a significant profit. So there's some natural liquidity generated that way. But for those investors, that actually want to exit their like position entirely before the 10 years has run past, right? There's a very vibrant secondary market that actually has around $50 billion worth of transactions in that market every single year. And these are where different participants in the private equity marketplace sell fund stakes but also buy fund stakes. And we as a firm have lots of experience actually helping clients sell and buy stakes in funds on the secondary market. So to just summarize that, there's great natural liquidity within the funds themselves when the managers exits, when they exit their holdings, and also the fund stakes themselves can be sold on the secondary market.
Right, so that's the mechanics of how you buy and sell these things. Let's move on then to the types of companies that you can invest in with private equity. So first of all, I mean, are there typical characteristics or typical differences that you see between the private and the public companies?
Yes, there are. I'd say that the most obvious ones, right, are age and size. With public companies tending to be older, larger, and much better established. But this has some implications, I'd say for public equity investors that don't consider private companies, right? Because these public companies tend to be just older if we're thinking about the company stages of life, right? So growth, etc. So, if you only consider large cap public companies, you're often missing out on significant portions of growth that you could get if you're investing in perhaps younger companies that tend to be private for longer, as Ben had mentioned earlier. Another key difference is that there tends to be much greater resources actually available to those public companies because they tend to be bigger, right? So whether we're talking about financial capital, physical capital, or also human capital, right? Public companies just tend to have much more resources to bring to bear if they face any challenges. And this is one area where private equity managers can actually have significant input into the private companies they own, right? Because they can give them financial capital, yes, but one thing that they can also bring together is lots of sector expertise, and in some cases they can even bring in new management that could help turn around the private companies that they own.
So lots more control over the investments, not just actually, holding a piece of it, but possibly influencing what they do as well.
Exactly.
So I think we're coming to favorite examples time. Can you just give us some examples of companies that have chosen to stay private as opposed to going down the traditional IPO route?
Yeah, sure. So there's some large companies that you might be familiar with. There's IKEA out of Sweden, that makes flat pack furniture. There's Bosch out of Germany that we know for their DIY tools, but they also have
Yeah.
a very, very big industrials business as well that actually serves other firms. And there are firms like Mars, that makes chocolates, which I love very much. Three things that one thing that these three companies actually have in common is that they're large, they're private, but they're family owned, and they have been for generations really because the owners just haven't wanted to sell up. But there's another example that I think actually illustrates a lot of the challenges that Bennett mentioned better, and that's Dell. Dell are a US company that makes personal computers, and they were founded in the 80s by the founder Michael Dell. They were a public company for a number of decades. They were very successful in the 80s and 90s and the early 2000s, but they started to suffer under lots of competition from other players in the market. So that's your Apples and your Lenovo's, etc. And the company was under lots of pressure from the shareholders who were seeing poor returns. The founder, Michael Dell, actually had a fairly ambitious turnaround plan that he wanted to implement in the company, but he felt that he couldn't do that under the glare of the public marketplace. So in 2013, he decided to take the company back private, right? And there was a management buyout, which is worth about $25 billion at the time, and he took the company private. He implemented that plan out of the glare of the public markets, and in 2018, the company went public again. And actually today is now worth over $80 billion. So that was an incredibly successful transaction. And that conflict, I guess, between management, shareholders, and the other stakeholders of a public company is something that's very, very common. As anyone who sees Elon Musk's Twitter feed will be able to tell you.
Yeah. Thanks for that, Joe. And now let's kind of maybe move on to implementation. So the practicalities of finding your manager who will go out and look for the good opportunities in the private market. So first of all, by the nature of these things, there's not going to be an index of private equity investments that you can just track passively. So presumably, Ben, everything's going to be on an actively managed basis.
Yes, it would be. I mean, just to take a little step back, we talked about the private equity managers going into these companies and transactions. A typical private equity fund would probably invest on average into maybe 10 deals. And if you think about your portfolio of private equity investments, you wouldn't want to just have one manager with 10 deals, right? There's potentially risk in that. So as we think about clients investing in the asset class, we want them to have a portfolio of funds built up over a period of time that allows them to get a diverse portfolio of private equity investments. And so yes, you would do that on an active basis, trying to find the best managers in certain markets or sectors, areas that you see as attractive, and try to build a portfolio of those funds out, as I say, over a period of time.
And so what's the kind of sweet spot in the number of managers then? I think looking at the other asset classes we're in this mini series, Ben, I think I'm getting the feel that kind of 10 to 12 or upwards of that is a typical number. Is that kind of the right ballpark for you?
So we think about it a little bit differently in private equity. As Joe's referenced earlier, private equity funds tend to be closed-end funds, which have a 10-year life, typically 5 years of an investment period, and then 5 years to harvest the capital thereafter. So you're constantly having to put new funds into the portfolio as those funds mature and distribute capital back to investors. So we don't think about it so much as the aggregate number of funds in the portfolio, but think about it more so in the number of investments you need to make per year as you need to continually deploy more capital into the asset class. So we think you probably invest in somewhere around the 4 or 5 funds per year. We like a selective, higher conviction approach. If you think about a 5-year investment period, that probably leads you to having a portfolio of funds around 20 to 25, I suspect, over time. So thinking about it a little bit differently than you would in a public equity portfolio, but that tends to be how we think our clients should access the asset class, and having that high conviction selective approach to funds is one we prefer. Others have different philosophies for their clients in that space, but we do want each fund to obviously make an impact on outcomes at a portfolio level.
Right. And in terms of all these different asset managers and thinking about their strategies for choosing the investments themselves, so what are the sorts of things that the managers themselves are looking for when they're deciding on which companies to invest in?
So it depends on the managers, right? So depending on what the manager's strategy is, they might be looking at a particular sector, for example. Maybe they're a healthcare specialist, and so they're playing in a particular sort of narrow niche that they're experts in. Joe's referenced sort of deal sizes and the area of the market, the size of companies that can be attractive, and so managers will have maybe different skill sets in a particular size band of companies. Perhaps they are specialists in companies under 100 million in size, or between 100 and 500, or you get the mega kind of cap funds that are looking at companies a billion, 2 billion and more, right? So each manager is going to have their own sort of discipline, their own level of expertise, and they will sort of look for companies that fit within their particular skill sets, right? As they look to, as we talked about earlier, an illiquidity premium and a skill premium driving returns where they feel they can add most value.
And any kind of common themes across opportunities that the managers are finding as kind of good value within the private equity space?
So we think in private equity, you need to really take a long-term approach to finding value, right? If you think about owning a company for 5 years or more, you need to have some sort of a process whereby you identify managers and sectors that you want to play in. And so when we work with clients in private equity, we tend to use what we call a long-term thematic approach. And I suspect you've talked about this with others in the other mini series around asset classes. We want sustainable returns generated from themes that we think are going to play out over a long time frame, be that around potentially global connectivity and the use of technology driving digitization around the world, or the need for cybersecurity spending by corporates and individuals to protect all of that stuff that we're doing online. So whatever the themes might be, and so we'll tend to try and work with clients to find managers and ideas that deliver along those themes, such that when you buy a company in 3 years time and you sell it in 5 years after that, in 8 years time, you think you've got a good handle on what's going to drive value for that company operating in a sector and an industry that is going to continue, frankly, to exist and hopefully flourish and thrive. And that tends to be that sort of long-term, as I said, thematic tailwind. This tends to be the starting point for how we go about identifying managers and thinking about the companies that they're going to buy.
And of course, one of the biggest of the long-term themes for investing in general, not just private equity, in 2021 is obviously around sustainability and ESG. And turning to you, Joe, maybe, I mean, how is the private equity industry handling that sustainability question?
This is an area that is very important for the whole investment market. But one of the things that I would say is that the industry is perhaps a bit behind their public equity counterparts And there are a couple of reasons for this, right? A key challenge that the industry has is just getting data for the companies that they own. So these companies tend to be smaller. They have much less resources than the much bigger public companies that we were talking about earlier. But it's an area where we see that actually managers are very willing to then engage not just with us, but with the companies that they own, to actually develop ways that they can measure a whole bunch of these metrics that we care about within ESG, and then manage those over time. And I'd say that some managers in the PE space tend to be better at this than others. But what's most important to us as a firm is not just where the managers stand today, but actually where they plan to be over the next 5, 10, 20, 30 years, right? And they need to show a very strong commitment that they take ESG very seriously, and also they need to show a pathway to actually measure a whole host of those metrics over time. But then beyond that, we actually see PE as an area where you can invest directly in a whole host of assets that can actually help you implement some of these ESG themes that we're very focused on today. So a very good example is the climate solution space, where we're seeking to give capital to companies that will innovate and launch new products that will, help us try and mitigate against climate change. And we, to give some examples of some of the things we've been doing recently, is we recently backed a manager that's focused really on companies that serve the EV market. So these companies actually, make different components that will ultimately go into the Teslas or the Audis, the EVs that we all drive. And then looking at what we're going to do in the future, we're actually currently just looking at a large private equity manager right now, that's also focused especially on that climate solution space. So lots of stuff to watch out for in this area.
Right, Joe. So just to let you know, we're going to have a separate conversation outside this podcast about electric vehicles, because I'm about to go down that particular path myself, and you sound like you know what you're talking about. So expect a call from me outside of this. But I think we're coming towards the tail end of this episode. So you've been taking us on I guess a tour of the world of private equity. But before we wrap up, obviously private equity is just, it's one important part of the universe of private investments. Ben, are you able to just paint us a quick picture for the other types of private investments, just in terms of the kind of broad categories that exist, maybe?
Yeah, sure. So I think the two things that really sit alongside private equity under that private markets banner you referenced, Locke, is real assets first and foremost. So I think you covered certainly a lower risk strategy into real assets, in secure income assets, in one of your other podcasts here. So hopefully familiar to listeners, but real assets encompassing all things related to real estate, infrastructure, and natural resources. And you can find higher return and higher risk ways of getting into the asset class that potentially can provide private equity like returns. And then the second category really is around private debt, which I think a lot of clients will be familiar with. It tends to be the first strategy you think of in private debt would be direct lending to companies that are quite often backed by private equity firms themselves. So looking to extract returns from lending capital to some of those companies and stepping into the place of where banks may have done so a decade or so ago. So those would be the two broad categories that we think can be attractive at certain times, and to clients looking to build a more holistic private markets portfolio, we think could be a part of that.
Thank you for that, and let's wrap up at this point. So really appreciate you coming on to the show, Joe.
Awesome, Locke. Thank you.
And also a big thank you to you as well, Ben.
Thank you for having me, Locke. Appreciate it.
So I think we are going to wrap up this mini-series in the next episode by looking at how all of this can come together in a well-designed portfolio. So please do tune back in then. But for now, do take care, and thanks for listening.
You've been listening to a Willis Towers Watson podcast. For more information, visit willistowerswatson.com.